Let's continue the conversation on Disney and Bob Iger. And for that, we'll bring in Michael Nathanson, of course, SVB Nathanson's founding partner, senior analyst, who joins us now. Has an outperform rating on the stock, target price 120. Michael, obviously we ended on the fight with DeSantis, which is not insignificant. But I'm sure from your perspective, it was more the comments about ESPN, linear networks, direct to consumer. What stood out to you from the interview, if anything, that you perhaps didn't expect, and what do you make of it?
David, thanks. It was great. There was so much there. I think what jumped out at us was acknowledging the truth in the room, right? Which is linear network. He could not be more negative on linear networks. He sounds like an analyst covering linear networks. But the challenge we have is with the identification of linear, ESPN looking for a partner. It's not satisfying the market, right? These issues have been surfaced. But what jumped out at us is we're still waiting for solutions, right? So we upgraded the stock when Bob came back on the idea that he's honest, he's decisive, and we're waiting patiently to see the payoff. But I would say the acknowledgement in very, very clear terms about the things that we're all seeing on our side of the ledger.
Yeah. We obviously, as we always do, spend a good amount of time on direct to consumer, though it's not as clear to me that there was anything precisely new there. I do wonder, though, your expectations, which, again, they're in the quiet period, limited in what he can sort of talk about. But it does seem, first of all, they're facing near-term pressure. No doubt he seemed to be, I think, talking about a quarter that just ended that probably wasn't great. But I'm curious about your thoughts about that. And then about direct-to-consumer, which obviously is still such a key part of the investment thesis.
Yeah, I'm smiling because when I listened to you and Cramer right after the interview, Cramer went right to that. Well, the quarter doesn't sound good. So we're at 89 cents for the quarter. Street's at 105. They've been saying things, there's been some stuff in the press about some weakness. I think that's clear. The longer-term issue, though, is to your point, is around DTC. And I think the lack of owning 100% of Hulu is limiting what they can say. And I think that's the frustration, right? The more that you need to fix DTC, but you can't do anything until you get Hulu in, is just a frustrating point. And I think what everyone's worrying about now is just in the short run, there's not a lot of earnings momentum. In fact, there's negative pressure, as you identified. And you need to get to the buy-in of Hulu to start another narrative, which is how we're going to integrate Hulu and Disney+. So we're in this really weird pattern of just waiting for more information, but seeing things get weaker as time goes on.
Yeah. On ESPN, what are your thoughts when he talks about a potential joint venture or even equity partner in some way? Do you go to Apple? What do you think about there as a possibility?
Yeah, a couple of weeks ago, you and I discussed the Disney bundle. Our view has been evolving, and our view is that Disney should have ESPN really in the bundle with Hulu and Disney+. That sports on a standalone basis, and you were pushing him really well on this, I thought. You kept going back to, well, is this a good business? Will it make money? We didn't get answers, but I thought, and I still think the idea is that ESPN should be embedded in Disney's content to have sports drive those products. So, I love the fact that you were trying to get an answer from him, but I still think that's the question, which is, yes, you can bring in partners, but is this a good business, and what's going to have to change to make it a good business? It stands as a very high fixed cost business that it requires a ton of either subscribers or high price points to make it a good business, and we don't see that, David. So, yeah, I was interested in that to bring in third parties, but it doesn't answer the basic question that you were trying to get to: is has this business make money on a standalone basis, right?
Right. Well, I mean, it's less than a month ago that you wrote a report about the Disney bundle being able to save DTC, which you're viewing, as you just said, I guess, Hulu, ESPN, and Disney Plus all being together. You think that is the ultimate solution to sort of being able to secure growth in the future?
Yeah. See, when it comes to sport, as a sports fan, you can see it from the guy behind me. You don't have all the sports in all seasons, right? So the risk is with ESPN over the top that once you get to baseball season, you cut ESPN over the top, or you get to college basketball, not a college basketball fan, you drop the service. You need to basically create either an all-in-one sports product with Turner or sport, Fox Sports or NBC Sports. So all sports could be there. Or you need to put sports inside someone else's content to get the NBA viewer into the Disney Plus environment, right? So it's either or. You need to have everything, or you need sports to drive engagement in a single app, right? So maybe when Bob is alluding to partnerships, maybe he's talking about partnering with other networks that have sports. Maybe that's what it could be. But I think you need to solve the issue of how does ESPN work a la carte, and we don't have that answer yet, right? So to me, it's putting, as we see now, put sports into Disney Plus and Hulu. So you and I would go into there, occasionally watch sports we want, but it would not be the sole purpose for going into the product.